trading friends, and welcome back to Forex Focus, brought to you by tastyfx. Taking a look at the recent ride that Japanese yen has been on and whether or not the Bank of Japan, the Ministry of Finance in Japan, Japan's whole economic ecosystem can save their currency from historic low levels that they're just recently bouncing off of. We'll get into the price action in just a second, but I'm sure you've heard or read or seen the prices yourself concerning the weakness that we've been seeing in this Japanese yen over the last couple of years, but especially in the last couple of weeks relative to US dollar, relative to British pound, relative to euro, and a number of other foreign currencies. Now we're going to focus on US dollar here today, but take a look at some of those other crosses as we have on the show in recent weeks, because some of them are getting pretty gnarly, and it's been yen downside across the board until recently. And let's take a look at the recent price action in dollar yen. This is the 1 minute chart, which is pretty granular, but I'm doing it for a reason that we're going all the way down to 1 minute, because we're looking at the CPI report that came out of the US here just recently. And, we talk about it on the show and on the site, so go look at that coverage. But essentially what came out is lower than expected inflation in the US, and US dollar gets hammered, right? As you would expect, lower inflation, more interest rate cuts from the Fed, weaker dollar. And the dollar's been really strong, as we'll show you in just a second. But what's really interesting is if you break this thing down to a 1 minute or 5 minute chart, that granularity will show you at 8:30 Eastern time, the number comes out and dollar yen falls about 70 to 100 pips, as you might expect. Dollar fell 50 to 100 pips against the euro and the pound and everything else in the same time frame. But what's really interesting is about 10 minutes later, dollar falls over 200 pips on no data releases, nothing new changed. Now, the dollar did see continued weakness throughout the rest of the trading session coming out of the CPI, but very interesting to a lot of traders that the dollar yen market might lose a bunch of value on the CPI report coming out and then kind of stabilize for a number of minutes and then get absolutely annihilated, crossing straight through 160, which has been a really interesting level the last handful of days here. It has been trading around highs, as you'll see in a second, for the last several decades. A lot of people chalking this up, and I think that Japan might have even confirmed that this was intervention on behalf of the Japanese yen currency from Japan's Ministry of Finance. And of course, they have not been new to this intervention game. The Japanese yen has been so weak in recent years that they've intervened on this currency on its behalf multiple times in the last couple of years, and this looks to be the most recent iteration of that. And it's actually stuck a little bit. And let's take a look at the longer time frame, and you see a couple of things, which is one, it looks like a drop in the bucket because trading from 161 and change down to 158 in the grand scheme of things is nowhere near what has been historically normal for this dollar yen market, which is the 100 to 110 range. And we'll show you even more data in just a second, going back to the 90s and the early aughts, where this market's traded in double digits. But before we get ahead of ourselves, this dollar yen market is up close to 50% since 2020. And since its lows of trading near 100, still trading above 150, is a high to low move of a low to high move of more than 50%, which is outrageous for a currency market, a major currency market here like the dollar and the yen. And when I say major, there are really four major currencies, and the dollar and yen are two of them. And for them to be combining for a more than 50% move in just a couple of years is a huge volatile move. Okay, So you know that this has been a rough ride for this yen, and coming into the CPI number, they were at that extreme of lowest prices versus the dollar since the 1980s, lowest prices versus the pound and the euro for the last decade plus. Really rough scene for this Japanese yen. But like I say, the CPI number comes out, they gain about 100 pips. The Ministry of Finance in Japan intervenes, they gain another 200 plus pips, and they've actually been able to hold on to that, at least in the short term. Let's see if it sticks. And let's also continue the story of how did we get here? What is causing this weakness for the Japanese yen? Because that'll lead to maybe what can pick this currency up in the longer term. These interventions are nice short-term spikes that the Ministry of Finance in Japan is hoping can continue a trend of yen getting back to more normal prices. But this isn't a scenario where they can intervene on this currency on a daily basis and essentially take it from 160 to 158 to 156 and on down to 100. It's not really feasible. What would be more meaningful is a shift to something like Japanese interest rates. And so here's a little bit more background on how we got here. The Japanese yen is super weak for a number of reasons, but when you're talking about currencies, the next place to go is almost always the interest rate in that region. And this is a really interesting chart compared to the US version of it, the Euro area version of it, the UK version of it, which is the overnight interest rate that's set by the Bank of Japan, just like the Fed funds rate in the US that's set by the Fed, has not moved really in the last decade plus. And that's factoring in the last couple of years where the Fed funds rate went from 0% during the pandemic to right now still at 5.5%. In the same time, the Bank of Japan did not hike its interest rate, and actually just a couple of months ago was able to take its overnight interest rate from negative 10 basis points to now 0. They're just getting back to 0. And so no coincidence that you see this yen getting absolutely pummeled the last couple of years in the same time that interest rate differentials between Japan and the US or Japan and the UK or Japan and the Euro area have widened out considerably. So much more demand for a US dollar where you can invest at 5.5% versus a Japanese yen where you can invest at negative 10 basis points. Like I say, though, they just got back to 0. And some of the upticks we've seen in yen that have been sold into, they've been short-lived, have been, okay, well, they got back to 0. Now they might hike. And if the U.S. starts cutting, then, man, that'd be a great combo for that Japanese yen. We'll see what happens. But let's dig a little bit deeper on why they didn't hike interest rates coming out of the pandemic like so many of these other major economies. Well, if you're tapped into China as well as Japan, the whole geographic region there throughout Asia has just not seen the same growth coming out of the pandemic as the US, UK, and Euro area, especially the US, obviously. And here we're looking at GDP growth rates going all the way back to 1980. And it looks like it's hard to read. It looks like, man, what can I take from this? Well, a couple of things. First of all, you haven't had consistently positive GDP growth rates really since the 1980s in Japan. But even if you put your eyes on the last couple of years, the dozen or so data points between 2020 and present, you've got some positive ones. You've got some positive, 1%, 1.5%, positive 0.5%, whatever. But you've got, almost half of those data points still showing negative. In the same time, the U.S. has been consistently positive, save for maybe 1 or 2 negative growth rates. Same for the UK and Euro area to a little bit lesser extent, but more consistently positive. And remember that the low to negative interest rates in Japan go back to prior to the pandemic. And maybe we can flash back to that interest rate chart really quickly, just to show that they've been negative actually since around 2016, 2017 range, and they have not hiked interest rates since 2007. And so this transcends just the 2020 to current period, and you can see that throughout the 2007 to 2020 period, you're getting a lot of those negative prints, not consistently positive. And so the Japanese yen lost some ground leading up to that pandemic. Like I say, prior to 2020, you saw some prints in the 80 handle, the 90 handle for dollar versus yen. It's just really taken another leg lower for yen coming out of the pandemic, because it was like, oh wow, now not only do we have low interest rates and low growth, but the U.S. now has high interest rates and high growth, and so we're really losing on both sides of things. Where they're not losing, and this is where things get really interesting, because you might think, okay, well, if their GDP is bad and their interest rates are stuck at low levels and their currency is getting wailed on, then their stock market must be getting killed, right? Well, no, that's one of the positive things for Japan, but also one of the things that's kind of holding them hostage is their stock market, looking at the Nikkei here, has performed very similar to our NASDAQ or S&P, which is to say a lot of all-time highs in the recent year or so. But keep in mind that all-time highs in the stock market can be fueled by a couple of things. In the U.S., we've had we've had the comfortable position of seeing all-time stock highs even with high interest rates. What does that tell you? Well, that tells you that there's actual innovation and growth from the companies that make up that U.S. stock market that's fueling higher earnings, revenues, and a higher stock market price at large. In Japan, a lot of this has been fueled on some of those same things, innovation and growth, but a lot of the quantitative easing that they've gotten used to, right? They didn't see interest rates hike before or after the pandemic, and the fact that the Bank of Japan has just gotten back to 0% and also in the same breath said, we're not in a rush necessarily to get to 1 or 2%, that's been a bad thing for the yen, but it has been a good thing for the Japanese stock market. And so, this is a really thin line that the central bank, the Ministry of Finance, the whole political ecosystem of Japan has to balance, right? Because the quantitative easing is keeping the stock market afloat, but also the low currency prices that they're intervening on could potentially reach a tipping point here where investors really pull out of their economy, don't want to hold this yen anymore, even though, the country's stock investments might have potential of ascending. I can get that strong U.S. dollar and strong stock returns. I don't need this weak yen and strong stock returns. So this is another piece of the reason why Japan might intervene on their currency, and also shows you how nuanced these situations are, right? I mean, if you're at a cocktail party and someone tells you, oh, well, if they just did this, then it would fix everything. Not so fast. This stuff is very, very complex, and the same idea that is keeping currencies really, really devalued in Japan is also keeping their stock market afloat. So we'll see how it all balances out. But just to close on this Japanese yen piece of it all and bring in some more historic prices for you to see here, if we can bring up the Japanese yen chart, you'll see that over the course of the last couple of decades, when we really widen out this lens to go back to around 2000, you see that there are plenty of points of trading in that 80, 90, 100 range. And in the grand scheme of things, if you take out the last couple of years, the really normal range is between around 90 or so and around 110. And so if you make a historical case for it, of course you'd think, okay, well, this currency is going to mean revert at some point. It'll come back. Maybe the U.S. will fall on hard times and they'll cut interest rates. Or maybe Japan will finally see some growth like they saw in the 80s, and they'll be able to hike, see a stronger economy, and that'll save this yen. But of course, the flip side to that coin is you look at the last couple of years, and even if you were trying to bet on that mean reversion, man, you're taking a lot of heat, because you could have made that bet from, shorting at 130 or 140 or 150 and now up around 160. Maybe this is the turning point, but maybe this is just another stop onto another historical extreme. But there you have it. You have all the dynamics behind why the yen is weakening, why Japan is trying to intervene, but how much they can do is it's tough to say. These interventions are usually pretty short term. What's more lasting is a change to interest rates, a change to the economy at large. We'll continue to follow the data and follow these potential interventions, because that dollar-yen price still north of 150, that's a historically interesting level. Thanks for watching.